Today for the Series 6 exam, we will cover the critical distinction between a variable annuity's separate account and the insurance company's general account. Understanding this concept is essential because it explains why a variable annuity is considered a security. Let's start with the general account. Think of the general account as the insurance company's primary investment portfolio. It's the pot of money the insurer uses to run its business and, most importantly, to back the guarantees on its traditional insurance products like fixed annuities. The company invests these funds conservatively, typically in high-quality corporate bonds and mortgages, to ensure it can meet its obligations. For a fixed annuity, the insurance company bears all the investment risk. If the general account's investments underperform, the insurer must still pay the guaranteed fixed interest rate to the policyholder. This is a key reason why fixed annuities are not securities. They are insurance products backed by the full faith and credit of the insurer, whose risk is shouldered entirely by the company itself. Now, let's pivot to the separate account, which is the engine of a variable annuity. When a client purchases a variable annuity, their premium payments are directed into this separate account. The name is very literal. This account's assets are legally segregated and held separately from the insurer's general account assets. This is the most important feature to remember. Inside the separate account are various subaccounts, which are essentially mutual funds offering a range of investment objectives, from aggressive growth stock funds to conservative bond funds. The client chooses how to allocate their premiums among these subaccounts. Consequently, the performance of their annuity is directly tied to the performance of these chosen investments. The client, not the insurance company, assumes all the investment risk. If the subaccounts do well, the account value grows. If they perform poorly, the account value can decline, and the client could even lose their entire principal. This direct exposure to market risk is precisely why the separate account, and by extension the variable annuity, is defined as a security. The Investment Company Act of 1940 classifies the separate account as an investment company that must be registered with the SEC. The variable annuity contract itself must be registered under the Securities Act of 1933. On the Series 6 exam, you'll see questions designed to trip you up on the distinction between these two accounts. For example, a question might ask, if an insurance company declares bankruptcy, which of its accounts would be protected from its creditors? The correct answer is the separate account. Because its assets are legally segregated, they cannot be seized to pay the insurer's corporate debts. They belong to the annuity owners. The assets in the general account, however, are subject to the claims of the company's creditors. Another common test question might look like this. An investor's cash value in a variable annuity is primarily determined by the performance of what? The answer is the separate account's subaccounts, not the general account. Here's a simple phrase to help you keep this straight. General for guarantees, separate for securities. The general account backs the insurer's guarantees for its fixed products. The separate account is for securities, where the client's return is separate from the insurer's guarantees and is tied directly to market performance. Remembering this will help you navigate those tricky questions about risk, regulation, and creditor protection.